The market has decided that the strong Canadian job numbers make a cut, an interest rate cut by the Bank of Canada next week, less likely. We did see the Canadian dollar rallying. Usually that happens when interest rate cuts aren't a near prospect. Let's get more from Brent Joyce, Chief Investment Strategist and Managing Director at BMO Private Investment Council. Brent, great to see you. Thanks for joining us.
Good to be here, Andrew.
I know it's just 1 month, but it certainly looks like the labor market's doing okay.
Yeah, it's on top of improvement across a variety of vectors for the Canadian economy. The news that's come out over the past days and weeks, GDP upgrades, productivity improvements that go back quite a distance, and capping it off with this employment report today.
Is it a big deal whether the Bank of Canada cuts or not next week?
No.
yeah, I know.
I mean, even looking out into next year, our outlook that we've released today was calling for the Bank of Canada to stay on hold.
Yeah.
We put a little parentheses there, maybe 1 quarter point insurance cut. It's in ink, it's in print, but I would scratch that for sure after this morning's news. What's interesting is we've seen the pricing flip now where no cut next week, no cuts next year, and in fact, toward the end of next year, perhaps some interest rate hikes, which certainly is a significant switch in terms of the direction.
Looking at to 2026, what jumps out for you? What do you think will be the main feature for next year for investors?
It's a positive backdrop. It's a supportive environment. Some of what's happened in Canada over the past couple of weeks is what we're thinking more on a global basis, that we get some of the chaos, the uncertainty behind us. We've got fiscal spending, nation-building projects here, all of that bolsters the economy. But a trajectory for equities that probably cools a little bit from the very strong, high double-digit teens type returns that we've seen over the past couple of years.
It looks like, as recently as April, the world was worried about Trump's trade war. But if we look at the stock market, it's had such a rally since then. It turns out, apparently a Financial Times journalist made up that expression, taco. Trump always chickens out. I didn't know that. But anyway, it looks like the market has decided these tariffs aren't going to be so damaging.
2 things to think about there. One that we were talking about back in April was the feedback loops that are put in guardrails. Whether that's the bond market, you saw U.S. Treasuries get to 5% back in April, and that was a change in tone from the White House. Stock market had its tizzy, but you've still got the judiciary, you do have Congress, you've got public opinion, lots of lobbying going on, particularly as it relates to U.S., Canada, Mexico trade relations. And so all of that has tempered and brought, I suppose, the taco that has markets calmed down. The other is the tariffs that are in place. They're being digested and they're moving through the system slowly. Jerome Powell talks about this. It's an increase in prices one time, but not all at once. And I think that's softened the blow as well.
What about this AI trade? Maybe we can put up the NASDAQ 100, or the QQQs, the ETF that tracks those.
Yeah.
Presumably we'll get some choppy trading with AI. These stocks have had such a run.
Yeah, this is normal behavior for new innovations. Those that innovate and discover these technologies get to reap these massive rewards, and we've seen a lot of that for the previous performance. We need to sift out the winners and losers as we go forward here. And now it's about taking that technology and spreading it to the rest of the economy and the rest of the world, which I think can be some productivity gains. Our forecasts aren't predicated on those productivity gains having to come to fruition, but it does bolster the story. And so we're moving into the next leg where more folks can eat from that AI theme.
They're spending these hundreds of billions on AI infrastructure, but who's going to pay for that ultimately? I mean, are companies going to sell much more advertising or goods? I'm not sure where would the actual profits come to justify that investment.
This is the healthy part that we're seeing over the past few weeks, is investors asking that exact question. And you're seeing a discerning parsing out of the winners and losers. Who appears to be able to monetize better and more quickly, right, on the AI theme, and whose plans don't look as well thought out, perhaps. And you've seen NVIDIA versus Oracle, Meta and Amazon and Alphabet all getting judged a little bit differently depending on what their answer is to that question. Remains to be seen whether the promise of AI is all that the exuberance leads it to believe. I think well-diversified investors participate in these themes, but also protect themselves by not getting too over-involved.
Maybe I'm just curious now, without commenting on the individual stocks, maybe we could put up a one-year chart for Google and for Apple, because in some ways they're arch rivals. Of course, all these tech companies are really frenemies, aren't they? Because what does Google pay tens of millions of dollars, billions of dollars every year to Apple to make their search engine the default on Safari?
Well, then others are getting into the chip space, right? That's going to challenge NVIDIA. So again, I think this is a natural competitive progression in a new innovation. You need to have the rewards there that incent the risk-taking to do the development. The thing that I think is important here, these are real businesses that have been around for decades that have fortress balance sheets. We're seeing some borrowing now into the space. It's still quite early and quite small. And so if there is a crack in the AI space, a little steam comes out of it, it's not going to transmit to the real economy through a whole pile of job losses in the AI names or credit contagion. Things that we had with the housing bubble, things we had with the dot-com bubble, those don't exist anywhere near the same extent today. And so sentiment would be damaged for sure on risk appetite if we were to see those mega caps take a hit. But the rest of the economy that's not part of that should see a quick recovery.
Although if these stocks really deflated, presumably there would be a wealth effect and the households that hold stocks would be inclined to pull back spending.
There's certainly going to be some accounting for that, yes. I don't think it's the entire story. One of the things that we look at with this bull market is the age of it is middle-aged. The breadth and the widening out this year has been very impressive. It isn't just the Mag 7 story. All right, Canada's a top performer this year. Europe's a good performer. Emerging markets are coming on. And so we don't have all of our eggs in one basket with 7 or 10 stocks like we may have made that argument a year and a half ago.
Brent, thanks very much indeed. Brent Joyce, Chief Investment Strategist and Managing Director at BMO.